Here. I'm here with Devin Norcross this morning. You're here with Lend Me Your Ear with Pat Cannone. This is episode 4. Devin Norcross joins me. He is with Norcross Consulting Services. He's the owner-operator of Norcross Consulting Services. He's been focusing on credit consulting and assistance for the past 15 years, and he's focused on the mortgage industry and then helping consumers repair their credit so that they can purchase a home. And Devin has come to bat for me many times across the past 4 years that I've been working with Devin and his team. So welcome aboard, Devin. I really appreciate you joining me today.
Yeah, thanks for having me on. I always enjoy these type of experiences to share information that myself and my referral partners have garnered over the years and help other people become homeowners.
Fantastic. Well, let's jump right in, Devin. What do you consider the best places to monitor?
Well, I think you got to figure out how and why you want to monitor your credit. If you want to monitor your credit to look for changes, to monitor for identity theft, to make sure that your credit card balances are reporting accurately, or you're not getting collections, there's nothing wrong with the free monitoring sites. There's nothing wrong with a Credit Karma or a Mint app or some of these other ones out there. Credit Sesame comes to mind. They update up to as frequently as once a week, and you're simply looking at the content in there of your report. What you're not doing is you're not relying on their algorithm to estimate your mortgage credit scores or your automotive scores or your credit card scores. Those lending products are going to rely on Fair Isaac Corporation or FICO's algorithms, and FICO does not have a contract with any of these credit monitoring sites. So if you are in a preparation stage for a purchase of an automotive loan, a mortgage, or an application phase of a line of credit, you're going to want more specific information based off how you're being scored by FICO's scoring algorithm, of which case your trusted lender can provide that to you. In the case of what we call a hard pull. A hard pull does come with an inquiry, a very moderate, very minor impact to the credit score, if any. Again, I'm going to say if any, that we talk about stuff called shopping windows where you're allowed a reasonable amount of time to do a little bit of shopping. The scoring model doesn't like a lot of hard credit pulls.
What is that reasonable amount of time, Devin? Because that is a common question that I get from folks. Obviously, not everyone, but a lot of people are very focused on credit pulls. So yeah. What do you say to folks like that? Because I know you've alluded to that briefly just a moment ago.
Yeah, well, there's over 60 different FICO scoring models, and a lot of them have different opinions of what we call a shopping window. The general consensus is it's between 14 and 45 days. Mm-hmm. It seems to be that most of them are clustering around that 14-day mark. Mm-hmm. What that means is, multiple inquiries within the same product line within the last 14 days we looked at as one inquiry. So same product line being mortgages. If you apply for a mortgage, then a credit card, then a car loan, you're going to get some penalty for those additional inquiries. Inquiries are very much like paper cuts. That's how I describe them to my clients in my presentations and in my enrollment and onboarding sessions. A lot of them can hurt, but they do heal very quickly. The one thing you really got to watch out for in inquiries, and it's really, again, unless you have very minimal open credit currently, because again, the more positive credit you have, the more insulated you are from things like an inquiry. But the biggest thing that with inquiries that we see in our space is really reckless credit application pulls through automotive loans, finance managers, and occasionally people who are just have a real habitual approach to applying for credit. Mm-hmm. But for the most part, I mean, I can't think of any time in the last 10 years that we saw a loan denied due to an inquiry or an inquiry affect a credit pull to where they couldn't get approved, or we couldn't recover those points very quickly and easily. But there is a workaround. So let's say your client is very concerned about the impact of that inquiry. They like to maintain premium credit scores. That's no problem. FICO, who we alluded to earlier, who calculates the credit scores for those product lines, they will actually give you their credit scores. Well, they'll sell you. Let me back that up. They will sell you their credit scores in what we call a soft pull format. So soft pull is when you're just checking the status of your credit. You're not actually applying for a loan. You're not actually applying for a line of credit. So the site for that's called My FICO. It's a great site. I carry it year round. It is $39 a month. In my opinion, if you're going to pay for credit monitoring at all, the only site you should pay for is MyFICO. It's myfico.com, and you can specifically go in there and see what your credit scores are based off the industry that you're looking to apply for a line of credit in. If you're looking to pay like for Experian Boost or some of the Equifax credit monitorings, I just don't think they provide you the resources that MyFICO does. And the only reason you pay is to get those credit scores. You get that information. If your credit score is sufficient for what you're trying to do, you reach out to your qualified lender, give them the green light to pull credit. If we're working on credit, we're getting the scores increased. So we're going to use MyFICO to see when we cross that threshold to approval.
Gotcha. Got you. Now, another common question I receive, I work with a lot of folks that have some blemishes on their credit and several collections. With regards to collections, what's your approach and what do you think consumers should do with regards to collections, whether it's medical or non-medical?
Yeah. Well, I have a great presentation where I provide examples of how paying collections can hurt the credit score.
Mm.
As a lender, I know you've seen it. It can
Yeah.
be substantial. What we have here is we have a difference in opinion on different scoring models, like Vantage, Credit Karma uses, or different FICO models on how they interpret paid collections. Universally, if you can negotiate that a removal of a collection takes place in exchange for payment, then I think you should pay as little as possible towards that debt in the form of a settlement and get that item deleted. That is universal green light go. As of recent legislative changes, as of July of 2022, paid medical is now deleted from the credit bureau. So again, universally, medical debt, work with me or on your own, but settle it for the least amount possible, and it will get deleted off your credit report typically within 30 days. Now, if we transition into some of the other debts like utility bills, cell phone bills, credit card, charge-offs, things like that, it really becomes a kind of a minefield. If you have a 5-year-old Comcast collection, it decreases in its impact to you in the exponential scale. So it decreases very quickly in a downward banana curve.
Mm-hmm.
So it weighs very little. You could have a $20,000 credit card collection from 5 years ago that weighs exponentially less to your credit score than a $50 cell phone collection that happened last month. So it's really the more recent stuff. If something is very new, paying it will not change the impact. So it's a good idea if you get a fresh collection off a new debt. If a fresh collection pops up off an old debt, then you got to be very careful, because now we look at updating what we call the data last activity. And that's really how the mortgage FICO models interpret paid collections or unpaid is off the data last activity. How long ago were you involved with this? Now, what complicates this is you have scoring models like the Vantage scoring model, which Credit Karma uses, and some of the new FICO models that exclude paid collections. So when you're using some of these monitoring sites, they will tell you if you pay your collection, your score will go up by XYZ. However, clients take that advice. Their Vantage score model, which isn't used in any lending application across the country, does see an increase, and their FICO models go down. I've seen scores go down 150 points on FICO models and go up 200 on Credit Karma. If you have 7 credit card charge-offs and in collection status and you go pay them all, none of those collections will be calculated into your Credit Karma score, and they will all be updated as if new collections in your mortgage FICO score. So if you are thinking about doing this kind of thing, really work with someone either in the space, a mortgage professional, someone who has experience in credit manipulation. I would even say, unfortunately, your local bank is probably not going to be able to give you the right advice on that. A lot of the handouts I see from banks just universally say pay all your debt. I'm a supporter of paying your debt, but I'm a supporter of doing it in a way that's not going to negatively impact your credit score.
Great. Yeah. And, speaking of credit card debt, and obviously right now we're experiencing extreme inflationary times, and people are tacking on a little bit more debt than they may have liked. And when a consumer is looking to, well, at any time, but especially when they're looking to purchase a home, what are your thoughts with regards to credit card balances and how they're reported and how they impact a credit score?
Sure. There are, one of the common misconceptions and the average person about their credit is that when they pull their credit, they're getting an information in a snapshot of time. So what I mean by that is if I pull my credit today, it's going to show my balances on all my accounts as of today. And that's not the situation. Most of these creditors, all these creditors, Bank of America, Chase, Discover, even down to your small collection of companies, they have to pay the credit bureaus to report information. All right. Now, how frequently they pay and how many of the clients they pay dictates how much they pay. So companies like Discover probably pay very little each month on a client, and some companies that update more regularly pay quite a bit more. That's why sub $50 collections are rarely paid, posted on the credit report because it just cuts into the cost.
Right.
So when they do, they typically report monthly. There are some clients that will report, save costs, report quarterly, some even less, but most of your creditors are going to report monthly. So we call that your reporting date. My Capital One card, its reporting date is on the 17th. Its due date is on the 25th. So if I pay my card before my due date, typically that is going to report to the credit bureaus a few days before my due date. So if I pay my card in that window between the reporting date and due date, the bureaus are going to receive my highest balance. However, if I were to adjust my behavior and pay my credit card down maybe on the 16th before my reporting date, then the credit bureaus would never know where my balance was. It would only show the paid down balance. So the only thing that matters to your credit score and where your credit card balance is where it is one day a month. And if you know that information, then you can beat the system. Now, it doesn't mean that you have money to pay these cards down, but instead of, in the home purchase process, can we adjust our behavior? Meaning what people are typically doing is they're getting their paycheck, they're paying their utility bill, they're buying their groceries, they're, paying the babysitter, whatever they need to. And they're putting down what they can on the card, typically covering their rotational interest. In this process, can we get to on payday, everything that can be paid with that credit card, we hold off on. We pay the card down before the reporting date. After the reporting date, we use the card to pay off those other debts. So really, our balance still stays the same, but we're making sure that the credit bureaus are receiving the lowest possible balance. And it's not to say that zero is the best. Actually, having no balance on your credit cards is a penalty if you have no balance on any card.
Right.
My personal credit score is very strong, but it drops 90 points if all my cards show a zero balance. Goes back up 90 points if one card has a $10 balance.
Yeah, I've shared that it's very counterintuitive with folks that they think, I don't understand what happened to my credit. I've seen that, and that's thank you for clarifying that point, Devin. So I honestly wasn't aware of the reporting date versus the pay date, and how that's a little tweak, a little hack that you can do, folks, to help improve your credit scores down the road. So
let me add one thing to that, because for years I've discussed this with clients, and what I've found is that about 50% of my clients will call me and they're unable to source the information of the reporting date. I've never not been able to personally find it. So here's my tip for anyone who is wanting to find out the reporting date. Call the number on the back of your card, whatever card you're seeking. You're going to follow the prompts to get a customer service agent. You need to ask if that customer service agent is in a US-based call center. If they're not a US-based call center, they're really encouraged to give you scripted responses. So one of the most important things at that point in time, in my opinion, is to you can ask for your reporting date, but if you're not getting a successful answer very quickly, you might want to consider requesting to be transferred to a US-based call center. I find that I can get to my needed information much more quickly and much more accurately. Sometimes it's a statement issue date. It's not always that case. But if you just stay on the phone, if they give you any answer that's not satisfactory, you just say, I'm sorry, that's not good enough. This impacts my personal credit score. You need to tell me what my reporting date is specifically. And you should be able to find that information out.
That's fantastic information, Devin. So, you've helped some of my clients in the past with regards to helping improve some credit challenges that they've encountered in order to purchase a home. Actually, quite a few of my customers. So what are the steps that you take with a typical consumer? Let's say they're, obviously every individual is unique, but, you've got scores in the 500s. They come to you for a consultation. What are the steps that you take in helping them get to the point where they can potentially purchase a home?
Well, with scores in the 500s, the first thing I look at is positive credit. I want to
Mhm.
see, what do they have? Do they have enough? Do we need to open up before paying off collections? It's actually better to go get a secured credit card if you
Yeah.
don't have a credit card open. The FICO scoring model puts twice as many points in the revolving category as does installments. So a lot of my clients in the mid 500s don't have credit cards. Their credit card's been charged off. We'll talk about debt negotiation in a second. Right now, it's more about rebuilding positive credit. And it's also where we would see, can we stop the bleeding? So some of these clients, especially if they're in the sub 550 category, are having persistent late payment issues. So number one, is it a good time to start this process with me financially? Are there accounts that are delinquent? And can we make sure that that's going to stop? I can't work with someone if they're getting late payments into some other category. It does not make any sense. So I want to address positive credit. We do a positive credit consultation, go over their trade lines, their open accounts, and then we talk about the negative items. And on the negative items, there's really two approaches. Well, three, if you consider time. Time will heal all with those negative items. They will fall off your credit report 7 years from the actionable date or the date of last activity. But how do we address negative items? So two ways. Number one, can we work with the creditor directly? Can we take reserve capital in the form of 401k money, family loan, savings, mattress money, and apply that towards these negative debts in a way that's going to improve the credit score? Can we settle credit card charge-offs? Can we negotiate the removal of collection? That's a great way to start, but it doesn't mean the client is in a position financially to do that. Or it doesn't mean that that's an option. Maybe it's a collection like company like Enhanced Recovery, where it doesn't matter if you pay it; they're just going to update it as a paid collection. It's not going to get deleted. If
Mm.
it's a 4-year-old account, we have nothing but downside on doing that. So then we want to look at what we call the Fair Credit Reporting Act's burden of proof clause, and this is really what the majority of the credit repair industry is built upon, and that's why we send letters to the credit bureaus on the client's behalf, and we contest items on that report using the burden of proof clause, which states essentially that everything on the report must be by law 100% complete, accurate, not misleading or obsolete, and verifiable.
Mhm.
So for my errors, my identity theft and fraud, my bad authorized user accounts, things of that nature, those are the first four requirements are going to attack those items. It doesn't necessarily mean that's where we have to stop, though. We do have legitimate items that don't meet the FCRA bylaws, meaning they are unverifiable. So the creditors have not passed down enough information to the collection agency. The collection agency has bought and sold the debt too many times. They don't have a complete file. The collection agency is out of business. They're not responding to the investigation request, things like that. This is how we get, again, maybe you have a debt that was a medical debt that was purchased by a collection company. That collection company filed a bankruptcy. It's out. That debt wasn't resold. And it hasn't updated in several years. So we sent a letter on that. We could test that. No response comes within 30 days. The credit bureau is by law required to remove that item. On some items, some loan products like HUD loans. So a lot of my credit repair clients will be FHA borrowers. I work with a lot of veterans. I work in rural areas for USDA loans. Those HUD loans allow accounts to be in a disputed status. So maybe you do have some paid collections. Maybe you do have some accounts with late payments on them. We could utilize the dispute process. And we don't have to see the full deletion of the item to get a full deletion of the impact to the credit score. So with our HUD loans, the government's decided that these are items they consider not to be an impactor of loan worthiness. They do not consider it a risk to their lending products. So if we have maybe a $1,500 credit card charge off, and we can settle that, get it, or pay down under $1,000, we can put that in a disputed status, and the negative impact will come out of the scoring agency, and the HUD will allow that to pass through their underwriting system. So we have a really nice workaround.
That's fantastic. And as I mentioned earlier, Devin has helped many of my clients. And mind you, folks, with myself here at Loan Depot, we can help folks with a credit score as low as 580. So as long as we get 2 of your credit scores at 580, we're at that magical point that we can assist you. And Devin, as I mentioned, has helped many of my clients get to that point. And mind you, once we get to that level and you continue to maintain that positive momentum towards improving your credit score, right now, obviously, we're in an environment with rising interest rates. But down the road, as interest rates decline, we can always refinance you into a better, either a better term or a better interest rate. So, thank you, Devin.
And one thing I would add to that is a lot of people forego working to continue boost their credit after they get their pre-approval. And typically in the lending process, you have a little up until within a short period of the closing date. to repull credit. And what you would, and Pat, you may want to explain this, but
Sure.
essentially you can give the person the interest rate they would have had on their lock date with their new credit score.
Yeah, what Devin is alluding to, and I highly encourage, is that you do continue to work on your credit during the process, because what we can then do is a rapid rescore. And with that rapid rescore, utilizing what improvements you've made, we go back to the credit bureau and we actually repull credit, and it's rescored immediately. And in many cases, we can get the score above 680, which will improve your chances of getting a conventional loan. So yeah, to Devin's point, you don't ever want to stop. If you've started that momentum in improving your credit, you want to continue that, especially if we have a window of opportunity to continue to improve it and utilize that rapid rescore. Absolutely. Devin, I wanted to touch on another point. Many of our, and I've mentioned this to folks as well, back in the day when I used to be a banker, and that is a secured credit card. Can you explain what a secured credit card is and how it can help a consumer?
Yeah, it's probably the single most powerful tool outside of the Fair Credit Reporting Act when it comes to rebuilding your credit history. People who have had bankruptcies that had to close all their accounts, people who have had, business failures, divorces, any kind of credit, any kind of challenges in life that led to their credit tragedy, or just learning along the way how to be a better, credit applicant. Typical entry level credit scores for unsecured cards. So you get a credit card with a limit on it. Maybe it's $300. Typically, Capital One or Credit One, First Premier, maybe Finger Hut, is in that 620. 620, 630 range. You really don't get approved for an unsecured card below that. You have some banks that make a little bit of an exception, maybe like a Navy Fed or something that one of these military connected banks. But for the most part, below that, you don't get approved for a credit card. And as I mentioned earlier, revolving accounts are twice as important as installment accounts to the credit score. So what do? Well, you have two options. Maybe you have a friend or family member that has a really strong account and they can add you as an authorized user. And that can, not guarantees, that can show up on your credit report and boost your score. Sometimes underwriters want those removed. Sometimes, that individual gets a late payment or increases their balances. Or sometimes those creditors simply don't report to the credit bureaus. You really want to also at the same time build your own intrinsic credit history. And so a secured credit card allows you to put a small deposit down, and typically that deposit is going to be your credit limit. So if you put a $200 deposit down, you have a $200 credit limit, and that bank really has no risk at that point in time. They do come with annual fees, usually in the $50 range or $30 range, and a lot of times some of the cards come with monthly fees, in the $5 to $10 a month. But it's worth it to build that credit history. There's a site I like called Open Sky. Their full website is openskycc.com. That's Open Sky Credit Card, so cc.com. And I like that card. It's actually a Capital One backed product. But I like that card because there's no credit inquiry. There is absolutely no credit hard hit. Everyone gets an approval. I've had clients with credit card charge-offs with every one under the sun. Everyone gets an approval with Open Sky. Everyone gets an opportunity to level the playing field.
And what I explain to folks is that you're borrowing against your own money. It's not a debit card, and this does and will positively impact your credit, assuming you make the payments, of course. Fantastic. Now, earlier in the broadcast, you had mentioned the purchasing the car, purchasing an automobile, and utilizing credit to do so. Obviously everyone's looking for a competitive interest rate. What suggestions might you have for consumers who are in the midst of purchasing an automobile or thinking about it?
Yeah, this is a very intimidating process for most people. Most people are intimidated by the sales process and by the finance process of purchasing a vehicle. Very afraid to make a bad decision. Very afraid of buying a lemon, and very afraid of getting into a payment that's too much. So a couple things I would say that would help the average individual in their purchase process. Number one, don't get payment blindness, meaning I can afford $500 a month. Also look at your payment times your term. If everyone out there took that piece of paper the salesman put in front of them and multiplied their payment times 72, and
Yeah.
then minus the negotiated purchase price of that vehicle, they're going to see what they pay on that car. And it's not uncommon for me to tell my clients that they're paying as much in interest as they are for the entire purchase price of that vehicle.
Wow. Yeah.
So the other thing to keep in mind is that a dealership will typically make more money than we would call back end profit than they will what we call front end profit. Here's the difference of back end profit and front end profit. Front end profit is what that dealership purchased the car at, plus what they put into it, their cleaning fees, their parts, their services, that full amount, and then subtracting that from their sale price. It is the difference between that. So what they're buying, invested in selling that car, and what they're selling it at. Back end profit is a profit they make when they walk that person to finance and they sell them extended warranties and they sell them an interest rate. If I sign you at a vehicle with a 9.9 interest rate, but I was able to get that deal bought at 5 flat, I'm going to keep 4.9% interest based off your purchase price right away from the person I sold the loan to. So what you are signing your paper at is typically not what that deal is getting bought at. That is just back end profit. So what I like to do is go to my FICO, figure out what your highest bureau automotive FICO score is. Is it TransUnion? Is it Equifax? Is it Experian? Use Google to see what credit unions in your area have a good, really competitive interest rates. Find that credit union and ask them, can you work with this bureau? Some only work with Equifax. Some can work with all three. But find a credit union that'll work with the bureau that has your strongest credit score. Have them pull your credit. They'll save that. Identify what vehicle you want. Get the VIN number for it. You don't have to buy that one, but start there. And then get a pre-approval process started with your credit union. And then put that piece of paper in your pocket. At that point in time that you do go to purchase your vehicle, let the dealership pull your credit. You show them that you are a qualified buyer. Then they can walk you on the lot, and then let them think that you're financing with them. Don't let them know you have your own personal pre-approval. And then negotiate very heavily on the purchase price of that vehicle, because a dealership will take a loss on the front end profit to make a gain on the back end profit. They also have to move units. It's how they impact their deals with their auction sites and their new car delivery package every month. So once you have that pre-agreed price, go back into financing and then give that finance manager your pre-approved letter and say, here's what I'm pre-approved at. If you can beat that, you can earn my business. And every time I've ever done that, the dealership has still figured out a way to beat that rate. In fact, last purchase I made, the dealership beat the rate I had with the same credit union that I had the pre-approved rate from. So I don't know how they did that, but they were able to. And then just still watch your term, still multiply your payment by your term, so you can get a good idea what you're actually going to pay for that car. And if you are in a position where you have to sign a high interest rate, or you are currently in a high interest rate, there are some really great national automotive refinance companies that can help you out. The one here in Denver is called iLending Direct, is a really good one. I have a contact if you need, but it is not uncommon for me to take someone at a 19.9 or 21.3 interest rate and get them refinanced out of that down to a 6% interest rate after we do a couple credit adjustments.
Wow. And that's a huge impact, as we know, with every point rise in interest rates, it has a huge impact on your monthly payment. So that's phenomenal hack, Devin. I had no idea. Thank you for sharing that. Um, Getting back to credit cards and credit card balances, what are suggestions or hacks that you might have for consumers as far as where they should keep, obviously, if and when they can, keep their balances at in order to enhance and improve their credit scores?
Well, I have a couple things I can say on this. So number one, we talked about your reporting date.
Right.
But that's not necessarily, if you're not trying to buy something, you don't necessarily need to manage your payment history by your reporting date. If you are just generally speaking, how should I carry my credit card debt? Well, of course, make as large of a payment as you can before your due date to minimize your interest. But keeping a balance below 30% is a really good threshold. So you are penalized as your balance increases towards your credit limit, as your utilization increases from 0% to 100%. You're penalized on the increasing exponential scale. So just an upward shaped banana curve. As you get to the top of that, you really lose all your points. So at 30% of your limit, mathematically, you're losing about 10% of the points available to that card. If you go up along that inflection curve of that banana curve, you go to about 50% of your credit limit, you're going to lose about 25% of the points available to the card.
Hmm.
And
Okay.
then it really starts to increase sharply. So at 75% of your limit, you lose about 90% of the points available to the card. Now, each card is weighed individually. And as a pie chart of the total applicable credit scores you have, 30% is based off your credit utilization on revolving accounts, and that is split equally between every card you have. So some people think you add up all your balances and you add up all your credit limits, and that total utilization number is what they're basing it off. It isn't. It is individual card based. So small credit limit cards really need to have your attention. A $200 Walmart card and a $20,000 Chase card, if they're the only two cards you have the exact same impact. They're both 15% of your score. So paying off a $200 card can yield as many points as paying off a $20,000 card
Hmm.
in that same situation. There is opportunity, and less every day as things get financially uncertain. But there are zero interest, zero balance transfer cards available. I think of a Chase Slate or a Barclay Ring card. Depending on how much risk is out there based off economic estimations, that sometimes they take some of these cards off the market. They
Yeah.
shorten the payback term. They increase the balance transfer fee. But it is usually you can find a zero balance transfer fee, zero interest card, typically for 18, sometimes even 24 months. So if you are in a position where you think you can balance transfer your high interest rate revolving debt to a low interest or no interest card and actually make headway in paying it down and not run up the other card, it's not a bad opportunity to really make a fast impact to your credit score, especially if you're stuck in that rotational debt cycle where you're just paying your interest or just paying your minimum payment. However, half the time this happens, they do that and then they go back and run up the other card. So it really is an exercise in self-control and will.
Yeah, that is the one danger, and it's something that you've got to take ownership of your present situation, and also set goals to ensure that what sets you on that former path no longer is going to be present, and you're going to be judicious about maintaining payments and paying those credit balances down.
You
Now,
can
I've had it. Oh, I'm sorry, Devin. Go
Yeah,
ahead.
let me touch on it. You can often get the creditor to stop charging you interest, but they're going to require the card be shut down. And the
Hmm.
problem with having a closed card in a good standing is this. We just discussed your score being impacted as your balance increases towards your credit limit. What your borrowers might know, but they should know, is that if your balance is over the credit limit, that's an additional penalty.
Right.
Well, what is your credit limit on a closed account? There's no zero, right?
Zero. Right.
So any balance on a closed account is looked at as a balance over its limit. So you have a
Hmm.
negative impactor by doing so. So again, if someone is really stuck, I really caution anyone who's made it this far in this podcast to really be careful talking to bankruptcy attorneys. Bankruptcy attorneys do not have a fiduciary responsibility to you. I've seen really reckless recommendations of bankruptcies to clients in the past. So it can be something where don't just auto defer to a BK if you have debt.
That's a great point, and great advice, Devin. Now, speaking, you mentioned bankruptcies, and I've had individuals who, unfortunately, through divorce or medical situations, their credit got dinged, and they've sworn off credit. And now they come to me trying to purchase a home, and either their credit scores have plummeted, or they have no credit because it's been years since they've sworn off credit. What is a good process that an individual can do to set themselves back on the path of having good credit standing?
I call it my post BK cocktail.
Hmm.
Okay. And that post BK cocktail is 3 accounts. It's 2 revolving accounts and 1 installment account. So 2 secured credit cards and then 1 installment account. An installment account could be a student loan, a car loan, it could be a secured installment loan, it could be a furniture loan, something. What I don't want to see is what we call credit builder loans. And you may have seen these reports, especially with like payday loans,
Yeah.
things like that. But these are like 6-9 month loans. FICO only gives you positive points for accounts that are open and active. So if you have 10 mortgages with perfect payment history and you pay them all off today, next month you could have no credit score at all. Okay. Certainly 6 months from now, you will not. It is only based off open and active accounts. So that's why revolving accounts are so important, is they can stay open in perpetuity. But what I would like to see is as long of an installment loan as you can stretch it. If you're doing a secured account, it's probably 24 months, and then 2 revolving accounts, and then don't forget the benefits of authorized users. Can you piggyback? Can you join someone else's card and inherit their history? If I'm 19 years old and I'm building my credit and I get added to my grandma's Kohl's card and it's 25 years old, my score is going to react as if I have a 25-year-old credit history on that account. So very important. We see it a lot. I'm always hesitant to even say it, but I highly disagree with a lot of the advice that Dave Ramsey gets. I run into this a lot with Dave Ramsey followers who are then looking to get traditional financing without 20% down, and they have a lack of credit or no credit.
Right. Yeah. That's, that hurts consumers. And I've seen it all the time as well, where they've sworn off credit, and we're in a situation where consumer doesn't understand why they're not qualifying for the best overall interest rate. So you should take Devin's advice, even if you haven't gone through a bankruptcy. Having 2 revolving secured lines of revolving credit and an installment loan, maintain and be judicious about making those payments. What I tell folks who don't like to use credit, well, just use the credit card to purchase your gas every month, your groceries, and then just pay those down, pay them off. And, you'll go a long way. Would you agree to maintaining your credit standing, doing something like that?
Yes.
Yeah.
Absolutely. I mean, it's another thing is that these again, with economic uncertainty,
right,
they will start to attract their large scale credit lines. So if you have an Express card you haven't used in 2 years, don't be surprised if Community Bank shuts it down.
right.
So in order to keep some of your old accounts open, because your older accounts are your bread and butter, make sure every 6 months you're either making a purchase. Like for Express, I will walk into Express once or twice a year. I haven't bought anything there in years. I go to H&M now; it's a third of the price. But I go in Express, once, twice a year, and I'll pick up something cheap on the way to the aisle and check out counter. I'll give her my driver's license. I'll key my social into the key card, and I might buy, a tie. And if I like the tie, I can give them $20 there in store and say, please pay off my Express card. And just right there, I made one transaction. It's ping Community Bank, it's ping Synchrony Bank, it's Gap, it's ping, whoever.
Right.
It's Kohl's, it's Capital One. Or as I've been known to do many times, is I'll walk out of the store and I'll walk right back in and I'll return the item. So what I've done is I've just registered a transaction. I have no debt. I don't have to worry about something being mailed to me. Community Bank knows I have a pulse. They're not going to retract that line. I mean, these guys don't know if I die. The Social Security Annex can eventually report that to the credit bureaus, but they have these debt lines out there. And if they start to feel there's too much adverse risk in the market, they will start to reduce those limits and eventually shut those lines down.
And, Devin, that's happened to me. I had not too long ago an old credit card that was shut down because I didn't use it. And that's a great point. Just go back to some of those older store credit cards and, make a nominal purchase. So, and if you like the item, keep it. Or as Devin indicated, you go out the store, go grab a bite to eat, and I changed my mind and go and return the item and get your credit back.
Yeah. Or if you are going to keep it, pay it off there in store if that's an option, because don't rely on that piece of paper to come in the mail and you may not get it, and then all of a sudden you're 30-day late because you're not used to paying that card. But without a doubt, the single greatest piece of advice I could ever give anyone in credit recovery is to get your accounts on auto pay.
Yes.
It is an exhausting feat to track every payment you have on a monthly basis.
Yeah, that it is. And well, I've got a couple more questions, but one, I just wanted to go back to FICO versus Vantage scoring. Could you once again clarify the differences between the two for us?
Yeah, so they are 2 scoring agencies. They are 2 companies that are filled with statisticians that look at the history of payments, and they make judgments based off your credit history on your future loan worthiness. All right, they are 2 competing factions. The FICO is a short term for Fair Isaac Corporation. It started in 1952 by Tim Fair and Scott Isaac. It's called Fair Isaac Corporation, and they have a lock hold down on every major lending industry. they have different algorithms based off different product lines. So the likelihood of you paying your car back if you had a repo is different than the likelihood of you paying your mortgage back if you had a repo. So your credit scores are different based off your lending products. It is a score that you can only get by paying them. So you pay them, or the bank that you pull credit through pays them. FICO will always get paid. You do not get free FICO scores unless it's a FICO 08 score, which your Mint app might give you, or your Equifax site, which is not applicable to the lending products we have that we use. Vantage Score was a joint effort by the credit bureaus to take FICO out of play. FICO gets too much money. The credit bureaus want that money. They're huge firms. Equifax has 14,000 employees. They're behemoths and they want to grow more. They created Vantage Score 1.0 through 4.0. We're on Vantage Score 4.0 right now. It differs than our mortgage FICO models in three major ways. There's no penalty for paid collections, medical debt under 500, or collections received in the last 6 months, which is where FICO would penalize you the most. What Vantage Score has said is, we believe that you should have a reasonable amount of time to identify that you have a collection. And if you still do not take care of it at that point, we're going to penalize you. So you have a bit of a window advantage on these new accounts. But again, your Vantage Score is not applicable for any lending product. So the sites that use Vantage Score, like Credit Karma, Credit Sesame, My Credit Keeper, things like that, you want to use those sites to look at the substance of the report. Is it accurate? Do I recognize the addresses? Do I recognize the inquiries? Are the credit card balances fairly recently correct? Are the credit limits correct? All right. Sometimes credit limits are reporting lower than your actual limit is, which increases your utilization rate and lowers your credit score. Capital One paid millions on this because they got caught doing it intentionally. So this is something that can happen a lot. And that's basically the update there. Just feel free to ask any questions, and your lender, Pat and his team, will be able to answer many of them. And if it's something that they feel is warranted to send my way, I'll be ready for it.
Yeah, and as I pointed out earlier in the broadcast, Devin has come to bat so many times for my clients, and we have many happy homeowners because of Devin and his team's assistance. Devin, before we sign off, because I want to be respectful of your time here, I ask each of my guests if there's been a book that's made a huge impact on their lives. Is there any one book that you've read that you think might be beneficial, not only obviously for yourself and your team, but others out there?
Yeah. I mean, the two books that I most recently read that were impactful were probably the same books that just about anyone here is gonna tell you. And I did audiobooks. I was on a road trip, ran a car back from New York, but certainly the David Goggins book, and then Extreme Ownership, which was Jocko Willenick.
Okay.
But both two really great books. I've also enjoyed things like Grant Cardone and Tony Robbins stuff. But I got a 1-year-old and a 3-year-old, and I haven't had a lot of chance to.
Yeah, I can only imagine, brother. I can only imagine. I've been there, done that. So fantastic, Devin, and folks. I'm going to also share the links that Devin indicated earlier in the broadcast. In the show notes when we during the broadcast. So again, Devin, thank you very much. Now, obviously, I can refer individuals to Devin directly, but Devin, if a consumer wants to get a hold of you directly, how can they do so?
My phone number is a great way. My cell phone number, which your consumer or referral partners are welcome to have, is 970-980-4946. My email is my first name, which is Devin, Devin, at Norcross, Norcross, and then followed by repair, repair.com. So Devin at norcrossrepair.com will reach me an email. And I always provide free consultations for anyone who's interested.
Fantastic. Devin, thank you so much for joining me on the broadcast today. Folks, as I mentioned, Devin has been instrumental in helping a lot of my credit blemish, credit challenged customers achieve the dream of home ownership. And that's what it's all about. We're here to work together to help you achieve your dream. Again, Devin, thank you for the opportunity to talk with you. I could talk with you for another hour because this fascinates me, because my passion in life is helping as many consumers become homeowners. And I know with your assistance and your team's assistance, we can do even more so for the general public out there.
Absolutely, and it's just becomes more and more important as the market moves on. It takes
Yeah,
its ups and downs.
absolutely. Thank you,
Yeah.
Devin, for joining me.
All right. Thank you.